Good afternoon, everybody, and welcome to today's Professional Advisor Working Lunch, brought to you with our partner, Schroders, on investing through uncertainty, why active asset allocation matters. I'm Ezra Baxter, News Editor at Professional Advisor, and I'll be your host for the next hour. Before we get going with today's session, let me quickly run through the usual housekeeping. I should inform you that the session is being recorded, and we will send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CBD, and we'll be sending your proof of attendance along with a link to the recording of the session, which will arrive in your inboxes tomorrow. So let's get on with the session that will look at how active multi-asset investing can help investors navigate uncertainty, manage downside risk, and uncover opportunities across asset classes. We'll be joined today by Tim Carr, Investment Director at Schroders, and Ella Davies, Multi-Asset Fund Manager, also at Schroders. In this session, Schroders, using real market examples and portfolio insights, will examine why diversification alone may no longer be enough and why active decision-making matters more now than ever. So do feel free at the end to put your questions to our speakers using the question box function, which you will find at the bottom of your screen. If you do wish to remain anonymous, then simply select my name from the drop-down list in the chat before you type your message so only I can see it. So just before I hand over to Ella and Tim, let me quickly run you through our learning objectives for today, which are: understand the nature of modern market uncertainty, assess the implications for portfolio construction, and understand how multi-asset strategies build resilient portfolios. So over to you now, Ella and Tim.
Thank you, Isabel, and good afternoon, everybody. I won't go through the learning objectives again. In line with the title of the presentation, I'd like to start with that uncertainty and where we believe that comes from and why it's likely to persist in what we've called the multi-threat world. And if I start on the left-hand side, if you think about the period anywhere after the global financial crisis, all the way through about 2022, all we really had to worry about was growth. Are we in a boom phase? Or are we facing a recession? There wasn't really any inflation to think about, to worry about. Inflation, interest rates were therefore low as a result. And the point is that was a period when a passive style of investing worked extremely effectively. We can't deny that just buying a global equity index and using some global bonds to hedge the risk was indeed an effective and highly performing strategy. But the rules have changed and our portfolios need to change as a result. So some of the things we'll talk about today, those other threats we now face, inflation is back and has been from 2022. We think that's structural. We think it's going to be persistent. We'll talk some more about that. But other things we need to worry about: market concentration, the percentage of a global equity index or any regional equity index that is taken up by a small number of companies, making in effect what was a passive bet an active bet. On top of that, we've got to worry about populist politics, and that in itself gives rise to both geopolitical risk and possibly policies that might make sense, appeal to the populace short-term economic sense, but introduce at the same time some longer-term economic challenges. And that sort of relates to the final point on fiscal sustainability. As governments look to finance those positions through debt, then bond investors start to worry about the levels of government debt and the ability to pay it back. And that has implications for bond markets and markets more broadly. Thank you to the marketing team for replacing Rachel Reeves with John Healy at short notice. But talking of uncertainty, I wanted you to just look at this, which says that uncertainty has always been around, and some of the lessons about staying invested through that uncertainty do persist. I think one of the challenges for you and for us is having clients stay invested through that uncertainty. This sort of illustrates why, or indeed, as many as have said to you, it's not just staying invested, it's getting them invested in the first place out of cash. So what I'm showing you here, all the way back to 1995, is if you put £100 into the stock market and done nothing, it's now worth just over £1,300, albeit that's been through a number of geopolitical events and market crises, as I've annotated on the chart. The scale highlights the magnitude of some of those. So in the global financial crisis, the market lost nearly 50% of its value. Even in COVID, it's over 30% of its value. So it's by no means a smooth ride, but our job as multi-asset investors is to deliver the returns, but smooth that ride and give those clients, your clients, the confidence to stay invested or indeed get invested in the first place. And the final point to make on this slide is if they don't get invested, the lines at the bottom show you what the value would have been by putting that same amount into cash. And clearly, it's a considerable gap in wealth by staying in cash. Just one more slide that may sort of help illustrate the benefits of staying invested. This one shows you the annual return on the stock market for each one of those calendar years. That's the bar where the stock market finished at the end of that year. Well, you know, volatility is not unusual. The dot shows you the corresponding low point in the market during that year. So even last year, when the market finished up over 18%, at its low point, it's down about 18% after Liberation Day. During COVID, of course, it's worse. The market's down over 30%, but finishes up at nearly 20% positive. So each year we see that level of volatility. And back to the point, it's up to us to smooth that path of returns and make sure clients stay invested or get invested to realise that upside. I mentioned geopolitical risk, and I just wanted to talk a little bit about this on this page, because geopolitical risk dominates sentiment and dominates headlines. But the point is, it's very difficult or indeed futile to try and trade headlines from an investment point of view. So all I've done on the left-hand side is show you the stock market return during each of the geopolitical events I showed you on the earlier slide, what the stock market actually did during that subsequent 12 months. And that's the grey line, and the blue line is the average. And clearly the point is, it's all over the place. You can't really predict it, and it's futile to try and trade it. What's really important is not the headlines, but how that transmits, how the geopolitical risk transmits into markets. And the right-hand side is an illustration of that, how two recent events have affected inflation. So starting at the beginning of last year, we had Liberation Day and the tariffs episode, in itself inflationary, and that did sort of cause an increase in inflation, and then inflation staying fairly persistent through last year until the tariff noise sort of abated at the end of the year, and there you see inflation drop off again until you get the Middle East situation this year. It's much more immediate impulse into inflation through higher energy prices, and they're the things we're looking at closely when we think about how that affects markets. So it's the fundamentals rather than the headlines. And indeed, inflation is one of those things where the fundamentals are most important and has a profound long-term effect on how we put portfolios together. So here I'm looking at on the left-hand side, the correlation between equities and bonds. In other words, how they move together. And that's the green line on the left-hand side. And it goes all the way back to the start of the previous century. But the real point is the right-hand side of that chart, where the equity bond correlation was negative for the first 20 odd years of this century, until the last few years when it's moved sharply positive, which means bonds have started moving in the same direction as equities. And why that is important is because that passive investment style of buying some global equities and hedging the risk with some global bonds no longer works, or is no longer as effective. So we need to be more active in how we make our asset allocation decisions. And I've tied it in with inflation. I've overlaid inflation in blue on that chart to show you really how it's during periods of higher inflation that the correlation tends to move more positive. And it was when inflation was low for such a long period of time that correlation was negative. And we expect inflation to stay where it is, or the risks are that it's higher. And the right-hand side is one illustration of that. The blue line shows you consumer expectations of inflation, which won't surprise you. It's much higher, not so noisy in the market expectation in green, but still higher than it was a few years ago. So we inflation to stay around, and therefore the equity bond correlation to stay negative, stay positive. So that's portfolio construction from an inflation perspective. I mentioned at the beginning market concentration. You'll have heard us talk probably before about the proportion of an equity index represented by the Mag 7. So I won't go over that again, but I did want to make the point that it goes beyond the Mag 7 and goes beyond the US. So the chart on the left-hand side shows you each one of those regional equity indices and the proportion of it represented by the top 5 and top 10 stocks. So it goes beyond the US, it's everywhere. Even in the UK, if you buy the FTSE 100, the top 5 stocks represent 36% of that market. Perhaps even more pertinent, even more in the headlines, is the emerging market index on the right-hand side. The top 5 represent 35% of the emerging market index. In fact, the top 3 are most of that. So the point for investors is if you're buying a global equity index, your risk is concentrated in just a few stocks. Now, that is fine if it's a deliberate and intentional decision, but it's not fine if you're just buying an index for diversification. So you need to manage that risk actively without labeling the point. The right-hand side just shows you the increasing proportion of emerging markets represented by Asia and, in fact, by the 4 countries listed. So market concentration is a risk that we need to manage actively. So if we've talked about geopolitical risk, inflation, market concentration, and fiscal risk, I think it starts to become pretty clear how a multi-asset approach can help. The fundamental underpinning of all that is always diversification, to spread our risks, not put all of our risks into one basket. But in this environment, that's not enough in its own. On its own, the risks are shifting, the regime is changing, events are disrupting the status quo. So it's important that we're flexible and dynamic and we get ahead of that and adjust our portfolios accordingly. Risk control is important, of course it is, throughout everything we do, but particularly illustrated with market concentration. By seeking to capture the returns associated with AI stocks and semiconductors. By way of an example, other returns are available, but we want to do that, but we want to actively manage the risk associated with it and size the position as we see fit rather than how the market index sees fit. So that's an example of risk control. And of course, it's all about building resilience into a portfolio and consistency, smoothing that path of returns, minimizing the downside so that those clients get invested and stay invested. Now, all of that, talking about multi-threat world and managing risks, can start to sound a bit negative, but it's not necessarily negative. Volatility and disruption also creates opportunity, and I really want to make that point before I go into the specifics of the portfolio and hand over to Ella. All I'm showing on this chart is the percentage of countries that are outperforming the US and how that's changed over the last couple of years. So all through the start of last year, you start to see a real move away from the US that we'd seen in previous years. And other countries, Japan, Europe, emerging markets, really start to outperform. The US comes back at the end of the year, then it goes out of fashion again at the beginning of this year, and then post the Middle East situation, we've seen that boom in AI stocks that has meant larger US stocks start to outperform again. And you will see later on when Ella presents the portfolio how we've adjusted our positions in the US and the rest of the world, and how it's important to be active because of that dynamic. So we talked a lot about the backdrop. Now we want to start getting a little bit more specific. I wanted to start with the cycle. I said about how the cycle is an important underpinning of our process, but we need to go beyond that. But the backdrop itself is actually reasonably positive. So here we show our growth and inflation forecasts around the world for this year and next, and it's not bad. It's not a boom, but it's not a recession, and we don't see an imminent risk of a recession. So growth is positive, but generally below long-term trends. But the thing to note is the dispersion in growth around the table. So at global level, 2.5%, slight increase next year. But you can see how the US dominates developed markets, and Europe, and particularly the UK, tend to lag. And while China looks good at 4.5 or 4% next year, actually reference its own long-term target of 5%, that's not especially encouraging for Chinese growth. Equally, China has more of a deflation problem, whilst you can see around the rest of the chart, we in the UK particularly have more of a sticky inflation problem. But that dispersion is food and drink for an asset allocator. That creates opportunities that we need to use to make those dynamic asset allocation decisions and gain benefits that we wouldn't get just by being a more passive global investor. I mentioned how the US continues to lead, and that's what we can see on this chart. Some of these charts are quite technical economics-wise, so I'll just try and draw out the main points from them. This chart just demonstrates the level of the left-hand side, the level of economic surprises in the US and the rest of the world. The blue is the US, the green is the rest of the world. And the point is, when it's a positive number, that means generally economic data releases are beating expectations, that surprises are positive. Equally, the converse is true. Data is coming in worse than expected. When it's a negative number, then negative surprises. And you can see a clear divergence where we're tending to see positive surprises out of the US and negative surprises elsewhere. I guess the flip side of positive growth is it does lead into higher inflation. So I mentioned we see inflation being somewhat sticky, and the right-hand side starts to illustrate why. It's a little bit technical, but basically the green line tends to, in history, predict the blue line being inflation, the green line being more of a forward survey-based measure of prices. And you can see the green line showing a sharp pickup, and we would, all else equal, expect realized inflation to follow that. So there are reasons to expect inflation to be sticky. Just finishing on the US, the driver of US economic strength is the consumer. And I wanted to look at the consumer a little bit more closely. Again, I'll probably get told off for three charts on one page, but bear with me. What we're basically saying is the headlines of the chart, that households are in a good position. They have been spending strongly, but there are reasons to suspect that might change. So the left-hand side just shows you the level of household savings in real terms, how that's picked up post-COVID. And that's one of the reasons why, despite higher inflation over the last couple of years, that consumers have felt able to carry on spending. And carry on spending they have, as the middle chart shows. The monthly, the middle chart, the blue bars, are monthly growth in consumer spending. And generally, there you can see they're all positive. So each month we're spending more than we did in the US the previous month. The blue line, the green line, just shows you the sort of momentum and trend in that data. And again, you can see it going up. So in good shape, have been and continue to spend. But of course, savings is not all there is to it. How much people get paid, their income is an important component of their sort of propensity to spend. And the right-hand side just shows you wage growth in green, and blue line is what's called the quits rate. That's people's confidence to give up their job. And generally, the blue line tends to predict the green line. So as people lose confidence in quitting their job and therefore getting another one, so wage growth, because they have less bargaining power, so wage growth tends to come down. Both have been coming down, as you can see if you squint closely. The blue line in most recent months has continued to go down. So there's pressure on wage growth. We think that will continue. That may lead to lower consumer spending, which may in turn affect growth and inflation. But for now, we think growth is fine and inflation is sticky. All of which leads, of course, into interest rates and makes the job of central banks more challenging. So I wanted to finish on these charts. This is the Fed. I'll come to the UK on the next slide. The blue line shows you the path of interest rates. The green is Schroders forecast, and the other two are what the market is and has been pricing. I think the point is, until last month, we and others had expected the Fed to stay on hold or indeed to cut. Our view was that they would stay on hold, but they took a noticeably more hawkish tone in their last meeting as they took note of that sticky inflation data and also the resilience of growth, which led us to increase our forecast for US interest rates to 2 hikes over the next 12 months. And that in turn has implications for how we see the US bond market and US assets. So that's important. For completeness, the other 2 lines, how markets are pricing US interest rates. The purple line shows you where they were at the beginning of the year. So as I said, pricing in quite considerable rate cuts. The Middle East completely changed that view, and now they price in quite severe hikes. Actually, it was way higher than that. I think they were pricing in 5 or 6 hikes at one point, which markets tend to do, overshoot. Our point is to make sure our prediction is on more fundamental levels. And now we're more in line with the market, which in turn means US bonds are about fairer value in our view. Okay, I've got 2 more on economics, then we will get into portfolios in the UK, where we all, of course, are. We know that inflation is sticky. We all feel it in our day-to-day expenditure. Actually, maybe surprisingly, sticky wage growth is one of the reasons why. And the left-hand side blue is wage growth in the UK. Yes, it's coming down in the same way it is in the US, but actually 4% year on year is not bad in aggregate. I'm sure variances exist. And then we've just mapped that against the green line, which is actual services inflation. On the right-hand side, explain what's probably fairly obvious to you, that higher wages equals higher cost for business, which feeds into inflation, which in turn tends to feed into higher interest rates. But I will come on to our interest rate forecast for the Bank of England next. And actually, for now, we think the Bank of England stay on hold. Here, it's not quite the same trade-off as the Fed have got, because, as I showed you right at the beginning, growth is less resilient. Growth is more sluggish in the UK, less than 1%. For now, the inflation being higher has been caused by higher energy prices, and UK is particularly vulnerable to that. And the Bank of England has shown a willingness to look through that and support growth. But I guess the point is, as that threatens to look more sticky for factors like that sticky wage growth, then possibly the balance of the risks is more to upside UK interest rates than downside. And that's certainly what the market thinks as well. Here you can see the market is pricing in hikes in the UK as it was in the US. For now, we think the Bank of England stay where they are, but I would acknowledge that the balance of risks is probably towards the upside. So we've covered a lot, the multi-threat world, but where that also gives opportunities, the economic backdrop. How does that actually feed into our asset class views and our current positioning? With that, I'll hand over to Ella.
Thanks, Tim. Yeah, so you've very nicely covered the uncertainty and the macro environment. And I guess the obvious question that sort of flows from that is, okay, what do we actually do with it? The headlines, especially recently, tend to make investing feel impossible. But what our job is to do is basically look underneath those headlines. And when you do, you can see that there are businesses that are growing, the markets are repricing, and opportunities are appearing. So what I'm going to do now is walk you through a few of those opportunities that we're seeing and how we're thinking about things. But if we start with equities, we do remain positive still on the asset class. There has obviously been lots of commentary suggesting equity markets are in one big bubble and they're going to pop at some point. However, when you actually break down, especially year-to-date returns, that's not really what we're actually seeing yet. And so what we have in this chart on the left are year-to-date returns broken down into buckets. And that blue sort of bucket is earnings. And you can see that that has largely been the biggest driver for most regions. And I think that's a really important distinction for us, because markets or sort of performance built on improving fundamentals tend to be a lot more durable than markets built purely on speculation. So that's one of the reassuring factors we have at the moment. Of course, it's different by region, and what you can see in the chart on the right is the predicted 2026 earnings growth for different regions. But that's exactly why we have active asset allocation. So we can sort of chop and change between those regions where we see fit and where we see opportunities. We've spoken about earnings. The most natural follow-on to that, I personally think, is valuations. And I think this is often where people become more nervous at the moment, because everyone is talking about how expensive everything is. And here we do have a rather busy slide, but if I sort of boil it down to what it really is, it's a bunch of different valuation metrics for the sort of top regions that we look at. And the dot in each of those bars represents sort of cheap or expensiveness. So the dot is current valuations, and the closer to red, the more expensive, the closer to green, cheaper it is. And so, yes, the obvious statement is nothing's looking super cheap at the moment. But valuations in itself only really tells half the story. And I think what really matters for us as investors is what a company's earning tomorrow, not what they were earning yesterday. And so if you look at forward valuations in this chart, so forward P, for example, that's second bar for each of those regions, things are not, again, looking cheap, but they're looking a little bit more moderate versus other valuation metrics. So it doesn't necessarily mean buy everything. You know, we still advocate for being selective, but there are definitely areas where we see earnings continuing to grow. And of course, again, we will avoid areas where expectations have simply become unrealistic as well. So let's talk about some of those specific areas that we're finding interesting at the moment in the equity market. So one area we've been thinking about at the moment is small caps. We've mentioned AI, 5 or 6 times already in this presentation, and that really has been the dominant story for the last couple of years. You know, investors piling into those big large cap names. But actually what you see on this chart, so the blue line represents small caps outperforming when it's above 0, small caps outperforming large caps. And what you can see recently is that has started to happen. And usually when you see a broadening out in markets like that, it's actually a pretty healthy signal. So what we're thinking about is, okay, are the next 6 months going to look like the previous? And is it going to be the large caps winning? There is a possibility that it won't be. So we are thinking about small caps at the moment. However, given AI is so dominant, we are constantly reassessing the case for it. So let's touch on that as well in a bit more detail. So AI, we do still have a positive view on it for now. Our view is that the theme is not over. We have seen a bit of a pullback, which again is healthy, but there are a couple of reasons that still remain very supportive for AI as a theme. And that's firstly because of the demand that we are still seeing. So if you look at that chart on the left-hand side, here we are showing the revenue growth for 3 cloud businesses, Microsoft, Amazon, and Google. And these companies, essentially what they do is provide the computing power that AI relies on. So it's a really good barometer of demand for AI in the market. And we can see that revenue growth is still picking up. It's got strong, healthy growth numbers still, which tells us that companies are still investing in it. Not only that, if we then look at the chart on the right-hand side, what this essentially shows is backlog of contracted business, i.e. business that these companies have won but are not yet feeding into their revenues. And again, you can see really strong growth there too. So the AI story still has a lot of support, but again, it's about staying disciplined. And that's because a great theme doesn't automatically make every company that sort of falls in that bucket a great investment. And that's where active management becomes really important. And I think this slide shows it really nicely. So we remain, positive on AI, but also many investors, when they think of AI, you immediately think of the Mag 7 in the US. Opportunities in AI are much broader than that. And the supply chain stretches right across Asia, which is what you can see in this chart. So you have companies in Taiwan and Korea that are absolutely critical to the AI supply chain. You have the chip manufacturers like TSMC, and then you have the memory providers like SK Hynix. So it's clear that AI is not just a US story, it's not a 7-company story, and some investors aren't paying enough attention to the sort of broader implications that AI is going to have. In the case of EM markets, the market has paid attention. They have done incredibly well this year, and you can see how the weights of Taiwan and Korea in the MSCI EM index has shot up massively, and that's because of the outperformance that we've seen. And you can also see how these EM indices are really highly concentrated. So look how much TSMC makes up of that index. It's huge. So again, there are opportunities that span more than one region, more than one sector, but there are still risks that really need to be carefully managed within the AI theme itself. And again, another reason why we're still optimistic, but arguably maybe a little bit more cautious than we were 6 months ago, is that enthusiasm for AI has already gone a really long way. And this chart essentially shows the flow into the semiconductor theme that we've seen. And you can see how extended it's become. It really has shot up recently. I will say, since this chart has been done, it's actually come off a little bit, which is actually quite nice. Again, a correction is healthy. But this shows again why active management is so important and necessary for participating in the winners within the theme, while also avoiding the losers and excessive concentration as the theme becomes more stretched again. That was a whistle-stop tour of AI. Now, we've covered the AI theme, where we stand. It's also important to zoom out at a regional level. And what this chart essentially shows is the evolution of returns for different regions. And what you can see is there has been actually quite a lot of change in leadership over the years. So it's by no means always the US that has dominated. And actually, if we speak about opportunities we're seeing in other regions at the moment, for example, we have a positive view on European banks in Europe. So there are lots of opportunities outside this AI theme, although it sounds like that's all anyone is talking about at the moment. That is equities covered. Now, on to the fixed income side, where we're a little bit less positive, particularly on credit. And that's, I'd say, for a couple of reasons. But the main one is that credit spreads are extremely tight at the moment. So again, a valuation slide for you. What you can see here is those little dots represent current valuations in different credit indices. And the closer to red, the more expensive. And you can see that those dots couldn't be further down, essentially, for most of those bars. And in simple terms, investors basically aren't being paid very much to take credit risk at the moment. So that's why we're happy to stay away. The other factor that could be a bit of a kicker at some point here is that with these big AI companies, they have done a lot of spending to build out their AI infrastructure. That has usually been out of their own cash. What we are starting to see are these companies issuing a lot of debt to also fund that spending. And so what you'll soon see is a lot of these AI names flowing into some of those credit indices. Again, I said we're happy with the AI theme, but we don't want to be doubling up on that risk. And that would happen if we sort of went full hog on credit as well. So we're actually underweight credit in our portfolios, again, for that sort of expensive valuation reason, but also if we see things, come to a head on the AI side, it can actually act as a bit of a hedge as well for our equity positions. Now, I've discussed our views. It's important to be aware that there isn't one, potential risk or outcome to our views. We'd be naive to think that we're going to be right all the time. There is a lot of, potential risks and outcomes. And so what we have on our desk is a scenario framework, which is really central actually to how we monitor and manage risks in the portfolios themselves. And what we do is consider a range of risks and essentially assign probabilities of likelihood to them. And then that way we can actually ensure that, one, we're aware of those risks, and two, that our portfolios are built in a way such that they would be able to withstand those risks if they actually materialized. And the grid on this slide shows those different macro scenarios that we're thinking about at the moment. And the actual grid, so it basically shows for each scenario their effect on inflation relative to our sort of core view on the y-axis, and also their effect on growth on the x-axis. Now, I won't go through all of these scenarios, but probably the most pressing one at the moment is the Middle East escalation one, top left. And what you can see is that because in that scenario you would have that shoot up back in the oil price, it has a sort of effect on inflation as in an increase, then also a decrease to growth at the same time. That's why it sits in that top left quadrant. And so, as I said, we have our views, but we're not naive enough to think that they're going to play out 100%. And so a formal consideration within our actual process of building portfolios really allows us to be aware of those things when we're actually building and making decisions. Now, this slide, go back to it. Similar to something that Tim has covered, but I actually just quite like it because it's the more recent examples of this idea of why, you know, you should stay invested and why you shouldn't wait essentially to get invested. And we hear this question time and time again. You know, we've got a plethora of risks at the moment. We've got geopolitical ones, we have inflation. But what history really tells us is that not only waiting to invest is uncomfortable, it's actually rarely the right decision. So what this chart does, it's similar to Tim's, but it just zooms in on whether you invested on the start of the global pandemic or the start of the Iran war. And essentially it's showing that if you had held on and invested on the worst possible day in those two scenarios, you'd still be positive in terms of your returns now. That's not to say, again, volatility doesn't feel uncomfortable. It does. We're humans, you know, but that's why we genuinely believe that active management is so important, because it allows us to adjust our portfolios and essentially smooth that volatility in those returns for clients. Now, if you didn't remember anything I just said in that section, I'd like to leave you with a couple of the sort of key points. Firstly, being that through uncertainty, whether it's geopolitics, it's growth, it's inflation, diversification is our most effective defense. And that's not just through regions, that can be through sectors, it can be through different asset classes. We have a lot of tools at our disposal. Then AI is obviously creating opportunities, but given real risks like market concentration and, you know, how broad the theme is already in certain areas, there are risks, but also opportunities. And then active asset allocation and flexibility to adjust the portfolios rather than just being static is really, really important, because markets are evolving so quickly at the moment. And that's because in an uncertain world, resilience, I think, really comes from not predicting one outcome, but being ready and adaptable in many. I will also skip through the learning outcomes since they've already been covered. Now, this part, this is where you can actually see, I guess, basically everything I've said in action. So this is how things have actually evolved in portfolios and what we're doing at Schroders with our multi-asset portfolios. More specifically, the Schroders global multi-asset portfolios. And as I said, if there's one theme that's really running through all of these sections today, is that the market's becoming more and more complex. There's opportunities, but there's risks. And so that's really the thinking behind the building of the global multi-asset portfolios. They're diversified with active allocation from the bottom up, from our underlying managers, the top down via us, at a passive price with strong risk management. And they're built to adapt, as I said, to that evolving market environment as well. And this is where you actually see that in action. And what this chart essentially shows is the positioning changes that we've made in the last sort of year or so. So we have here, it's not exhaustive, but I think it's a really nice way of showing all of the tools, or some of them, at our disposal. And the green bars represent times we have been overweight certain things, and then the red bars or pink bars represent when we have been underweight certain things. So taking you on the journey of our year that has already felt longer than 6-7 months. But right at the start of the year, we were very positive on US equities, US growth. We had a Fed that was cutting rates, which may or may not have been the right decision, but ultimately supportive monetary policy is very good for risk assets like equities. So we were overweight US equities. We then had some green shoots via fiscal stimulus in China and Europe, which we assumed would help boost growth and the consumer. So we were overweight Europe and China. However, we were still underweight US government bonds at the time. And as I said, that's because you had a Fed that was cutting rates, but actually while inflation was still elevated and growth was very, very strong. So we didn't feel like that was the right thing to be doing. On the alternative side, we had gold and industrial metals. They were great diversifiers at the time. They also had their own fundamental stories as well in terms of supply and demand that we were seeing for these assets. So we were happy to be overweight. And then the war broke out in the US and Iran. And what we did in response pretty quickly is dial down some of our overweight equity positions. So we took off Europe and we reduced the size of our China overweight. And that's really because those were two regions that we felt were really exposed to that sort of energy price shock and that energy angle as their sort of oil importers. And then we also, which isn't on this slide, we actually added a energy position as well, which again, I think is a brilliant example of why dynamic asset allocation matters, because by adding that energy position, it also meant that we could hold on to our remaining equities that we had on the portfolios. And if we hadn't had done that and, we experienced that sort of de-escalation where equities shot right back up, we probably would have locked in losses right at the worst point. So that's where being able to be nimble and move quite quickly really helps to smooth out that path of returns and allows you to stay invested as well. So where that takes us today, we are still overweight equities via the US. We are also now underweight credit rather than government bonds. And that ties back to the point that I said about expensive valuations and a bit of an AI hedge if worse comes to worst. And how finally that has played into performance. So very briefly, it's been strong over all of the periods on this slide. And when you unpack it, again, it's down to our underlying managers, and it's also down to our dynamic asset allocation. Again, as I said, we held on to our equities. We are now, in profit on those positions. However, we wouldn't have been able to do that without buying energy, which also is in profit. So with that, I will hand back to Isabel.
Thank you both so much for that great presentation. So we do have some time left for questions. So one of the first ones here for you both is to give an outlook for emerging markets.
I'll do that.
Yeah.
Yeah. We are actually, I would say, positive on emerging markets at the moment. However, I would say there is dispersion within the EM block itself. So the thing with EM that's always rather tricky is that when you say EM, that's 20, 30 different regions. So I would say we are positive on EM, but our positive view lies more with places like Taiwan and also China. And that is very much at the moment based on the belief that these semiconductor companies in those regions are going to continue to do very well. They'll continue to have very strong earnings and pricing power. So yeah, we are positive on EM for now.
Great. And we have one here on the multi-asset side of things. So do you think that there is a danger in over-diversification during times of instability, trying to miss a negative rather than attempting to maximize returns in a smaller pool of funds?
Didn't quite catch the second part of the question, but the first part of the question, is there a danger in over-diversification? Yes, absolutely. I think diversification is not a sort of cloak to hide behind. It's a valid principle for spreading risk around, but it needs to be targeted and deliberate. So we spend a lot of time constructing an asset allocation that's based on long-term return forecasts and volatility and correlation amongst assets. But the point is, ultimately, every position has to earn its place in our portfolios, whether it contributes to return or helps to reduce risk, or maybe a bit of both. It's not in there out of, dare I say it, lazy diversification or lazy portfolio construction, because then you just end up average if you over diversify or worse. So I think I agree with the sentiment of the question. You can over diversify. I'd argue that we don't. Our diversification is very deliberate. I don't know if I did answer the second part of the question because I didn't quite catch it.
Yeah, the second part of the question is trying to miss a negative rather than attempting to maximize returns in a small pool of funds.
I think that ties into what you said.
Yeah.
I think the risk scenario grid is probably a good representation of that. I think, we as investors have to take a view. Yeah.
Perfect. And next one is, as AI mega caps dominate developed market equity indices and energy policy increasingly diverges by economic policy, how do active multi-asset investors actually diversify when traditional geographic and sectoral splits no longer provide genuine risk separation?
I mean, I think the sort of main point to make here is that you're right. A lot of the big themes at the moment, there's sort of cross moves across different regions, across different sectors, but that's, I think, within an asset class, right? That's within equities themselves. We have, as multi-asset investors, the ability to look at FX, and that's more the theme of sort of what's happening between central banks and divergence there. We have the option to diversify or play on alternatives via commodities. So I agree there is a sort of common thread that's across different regions and sectors within equities, but I think where we have the ability to leverage different asset classes, there are other themes that are going on there.
Great, thank you. And do the panel see interest rates increasing in the UK as a result of geopolitical inflationary pressures, and what effect would they have on shares and bonds?
So at the moment, we don't see UK interest rates increasing, as I briefly covered in the presentation. Our forecast for them to stay where they are because the Bank of England is balancing weaker growth against higher inflation. And at the moment, have shown willingness to look through short-term inflation, which is only price-driven, to not disrupt growth even further. But if that inflation gets stickier, then they've probably got no choice but to raise rates. And we do, and I acknowledge that the risks are skewed in that direction. And look, all else equal, that's probably a negative for investing in the UK. I mean, we might get a boost to the currency, but it probably disrupts equity valuations. It has a short-term impact on gilts. But to us, we sit in the UK. That's the reason why we don't want to have a UK bias. We're global investors. The opportunity set out there is large, and we'd use it if we become more negative on the UK. So don't see in the base case higher rates in the UK, but if we get them, it's probably slightly negative, but we've got the ability to go elsewhere.
So we have another question here, which is the Street advocates diversifying from US into Japan and emerging markets. However, global supply chains tie these regions closely to AI. Since geographic rotation doesn't eliminate this concentration, how is Schroders structuring portfolios diversify away from AI capex dependency and capture non-correlated returns?
Yeah, as I said, I think it ties into the earlier question. There is this thread that's running through different regions at the moment, and it is AI. So I would probably categorize US and EM as dominated by that theme. But if you look at other regions, so Europe, for example, if you look at your sort of typical European index, Euro Stoxx 50, the highest weight in that is financials. And actually, that has a sort of an earnings expectation that's probably quite separate from AI. Now, I'm not going to shy away from saying that if we see a popping of a bubble, that will probably ripple across other themes, other parts of the market that look like they're sort of mutually exclusive from AI. But again, that's within equity markets themselves. Where there are other stories going on are things like commodities. We have a view on miners at the moment, in particular, because there's increased demand for copper, but not enough supply. So there are lots of things out there that are separate to the AI theme. It would probably just be played by us outside of equities. It would be in bonds, it would be in FX or commodities or alternatives.
Great, thank you, guys. If we didn't get around to your Tim, I
think there
run through
seemed
the webinar's learning objectives of what was discussed today, understand the nature of modern market uncertainty, assess the implications for portfolio construction, and understand how multi-asset strategies build resilient portfolios. So now, as PA takes a break through the remainder of the summer, let me leave you with a teaser of our packed schedule events when we return in action in September. Our autumn multi-asset and MPS Roadshow gets underway on the 9th of September in Harrogate, and on the 10th we'll be in Warrington. The following week you can find us in Cardiff on Tuesday the 15th, and on the 16th we'll be at Lee Court in Bristol. We'll be rounding off the roadshow at the National Liberal Club in London on Thursday the 17th. On this roadshow we have a magnificent 7 presentations from Aberdeen, Aviva Investors, Clever IM, Downing, Fidelity, Quilter, Cheviot and Rathbones. The following week we'll be in Scotland for our traditional Scotland Advisor Roadshow. On Wednesday 23rd, we'll be in Edinburgh, where we've moved the event from the city centre to Murrayfield. It's easy to reach to by car and by tram, and there's masses of free parking, so we hope that this will make it easier for people to attend. The following day, the 24th, we'll be in Glasgow. Our presenters on this roadshow are Evelyn Partners, Morningstar, Orbis, Schroders, Trinity Bridge, and our keynote speaker of portfolio thinking, Dan Kemp. We start October with a bang on the 1st with our flagship Northern Conference, PA 360 North, at the Park Royal Hotel in Warrington. This is now firmly established as the biggest annual management conference for financial advisors in the North, and this year will feature presentations from over 20 organisations. It's a full day's conferencing, and if you were there for the last 2 years, you'll know to book early as it's been a sellout for the past 2 years. All in all, that's 15 hours of CPD on offer, and if you wish to find information on or sign up to any of our events, you can do so today by visiting freshandadvisor.com/events. So that's it for today's session. All that remains for me to thank Tim and Ella once again for their presentation and answering the questions. But as ever, our greatest thanks go to you guys, our readers, for your company this lunchtime. I hope you found the session helpful and worthwhile, and we hope to see you again soon.